Hello traders, good morning from Chicago. It's 8:02 a.m. Central Time on Thursday, July 17th, 2014. Derivatives trading involves substantial risk of loss and is not suitable for all investors. My personal opinions, market data, and recommendations subject to change without notice. Past performance is not indicative of future results. So some interesting things happened overnight, along with interesting structure left behind by the ES yesterday. I'm still focusing on the ES because it continues to be the most popular product traded, so it hits the widest portion of the audience here. Although I'm more of an advocate for the Nasdaq and other products right now, I feel like the ES doesn't provide us the same quality of opportunities as some other products do right now. But we'll continue to discuss the ES. Let's go over the overnight news. Most of you know the market had a decent drop, mainly driven by the announcement by the U.S. Of U.S. sanctions against Russia. Now that announcement came out yesterday at about 3 Central, 3-4 Central, but had little to no reaction because there were no details at that point during the Asian markets. However, these sanctions are against one of the world's largest oil companies, and as such, we saw a reaction in oil. So the Rosneft is the world's largest oil company. It's also, the sanctions do not target, they're different than they were last time, because in the past the sanctions were more symbolic. They were against several Russian individuals and some business interests of those individuals who are believed to be causing a destabilization of the situation in Ukraine. These sanctions that were just announced are much more direct. They're hitting the oil sector, they're hitting the banking sector, a series of large banks and energy and defense firms. So it's quite an escalation by the U.S. against Russia. Also, the EU agrees to expand its sanctions on Russian companies in line with the earlier draft. Will decide on list of targets by end of month. EIB to suspend new lending to Russia, and will look to suspend EBRD lending. At the same time, the Pentagon's Russia is reporting that Russian troops are building up on the Ukraine border, and the Ukrainians are reporting that a Russian warplane shot down a Ukrainian warplane yesterday over the Ukraine. So that situation is back on the front burner, and it looks like it's deteriorating. In addition to that, overnight, the Eurozone June CPI final year-on-year unrevised came in at 0.5%, in line. Remember, CPI inflation is the big component for the ECB to make or adjust its policies. Fed's Evans, in an interview with Hills and Rath, said that the labor market's improving faster than expected. Strong jobs market does imply an earlier hike. Fed's Fisher came out and said that confirmed that the Fed's likely to start hiking early next year, should taper investment before hiking. And then he also said that the stock market is rich by almost any measure. So further on Yellen's comment from 2 days ago regarding the valuation of some techs and biotechs, which sent the Nasdaq dropping really fast. Other than that, initial claims came out at 302 versus 310. A little bit better. U.S. housing starts had missed by a fair amount, 893,000 versus 1.02 million. So that's a firm miss. U.S. continuing claims came in at 2.507 million versus 2.58 million. Looking ahead, we have Philly Fed at 9 o'clock Central, expecting 16.0. At 9:30, we have EIA Natty Gas expecting 100 billion cubic feet. At 12:35, Fed's Bullard on monetary policy. And then we have Google and IBM after market. Google is expected at 6.25 earnings per share, $6.25 for the Class A shares. IBM at $4.31. Okay, I'm not seeing much on the supply equation. There's auctions. Let's take a look at the markets real quick. I'm going to try to keep this as short as possible. I'm going to start today, instead of looking at yesterday, I'm going to start today with the overnight chart. If we look back here, let's switch this to a 30-minute, just to be able to show what I want to show. Chart switching to 30 minutes. Okay. Sooner or later, it's going to have to give me control. All right. So we made all-time highs here on the 3rd of July, Thursday, at 1978.25. We pulled all the way back down to 1945.25. This is the move here on the Yellen comment. And then yesterday in the overnight session, we went to 77.75, and then on the open we tested 78. So we one tick failed auction against the 77.75, and we were one tick short of the all-time high. So what we have essentially is a double top, but the existing high, the quality of the existing high is pretty poor. So if we look at the existing high here, 78.25, point of control is right up against the extreme, and it looks like a weak high, not the weakest of highs that I've ever seen, but a pretty weak high. And then yesterday pushed to 78, and then pulls all the way back almost to the point of control of the prior day. This is the overnight session yesterday. And you can see that we left a weak high on the overnight session as well, which we successfully took out by a tick, and then we walked away. So what we have is essentially a double top, a genuine double top yesterday before the sell-off. The market came back to 76.75. I considered this, as I was talking about this in the afternoon, I was tweeting about it, I consider this a pretty bullish move. It looked like it pushed down to the point where it found buyers. There's a very good low to put in. It seems like we found a strong buyer down here. As you can see, this is a pretty decent low that was put in yesterday before the market rotated back up. So to me, it looked like the market was staying firm in that it was moving the point of control up on the day session, built a nice value area up high, and has moved away from the low end and pushed to the high end, and is holding that area, which is also above the mids. So we look at the session only, it's a little bit more clear that once we tested into the prior day's value area and so on, we found the buyer and came back through. We pushed through the mid and then tested the mid from above and held firm. The fact that it came all the way back to the open told me that the high of 78 and 78.25 are in jeopardy. Unfortunately, the overnight session changed all of that, and as we all know, every time the market has sold off to what it's doing now, it's able to find buyers in haste. So let's look at what we have done. Yesterday we gapped up at 76.50. The prior day's close at 68. We tested 78. We took out the overnight high by one tick. We have a failed auction. Market comes back to put in an OS low. The opening swing low. So the first seller we found at 78. The first buyer we found at 75. Recall the 75 is that key LVN zone that I've been talking about for several days. And it bounced back up to the opening print to the tick again. So really interesting auction on the open yesterday. Very methodical. Goes to 76.50, which is just a tick above the prior day's high. Unable to hold those prices. It's also the mid. Falls back into the prior day's range, and then on a retest, not able to get out of prior day's range. So the expectation is for a further rotation down. I had outlined in yesterday's Trader Bite 71.50 and 71 as the key areas to test below if it gets back into the range. I expected it to come down to the 71 area, balance for a bit, find buyers, and push back through and take out the 78. That's not exactly what happened. It actually pushed it deeper in than I had anticipated. Pull back to the mid, fails through a little bit, then it gets really choppy. The volume actually drops off a cliff at this stage. It wasn't even an hour into the session, and then we see these zipper formations, and then finally the market takes the IB low out by 2 ticks, retests, and breaks through. This whole area was just it's just not a pretty trade. If you didn't already have a short on from way back here, getting in this area was just not fun. At 69.25, it had basically pushed in by 7 ticks through the 71, and then couldn't quite get to the prior day's close or the point of control, which is what was expected. We expected it to push. If it's going to go in to value, then the expectation is that it would push to the point of control at 67.75. It just could not do that. Stopped a 1.5 short, and it found buyers. Now look at this. Look at this delta here. A pretty decent delta. This is what the market looks like when it finds buyer. A pretty secure low, very low volume occurring there, and the market puts in a wide rotation in the other direction. To me, this is a classic example of how the market's expected to react when it finds the opposing force. Remember, the market moves lower not to sell off. It moves lower to explore for buying interest, and it moves higher to explore for selling interest. It'll keep advertising higher and higher and higher prices until somebody says, hey, this is a good price for me to sell, and then they start selling, and then the market responds with other participants stepping in. If you want to see how the market really works, rather than looking at it through the eyes of eyes of indicators and lines and trend lines and so forth, all you have to do is pull up a YouTube video of a cattle auction or car auction. There are many car auction videos that show you how this process works, and it also explains why we look for the opening swing high and low. In those auctions, it's very clear that the auctioneer, even though those auctions are one-way auctions, these are two-way auctions. We can be the supplier and we can be the consumer of this product at any given time with just a mouse click. That's not true for a true auction. The person, the car or whatever, you can't suddenly bring your car in and start selling it in the middle of the auction when prices get high enough. So it's a little bit different, but it provides the same kind of habits where in a car auction you would have the beginning bid, and then the auctioneer sees that there's no interest at the opening price, which is for us was 76.50. The auctioneer sees that there's no interest in the opening price and will continue to actually reduce the price until the first person raises their badge or paddle or whatever, and then you'll see that other people will start participating, and then price will move away. So what that auctioneer did is he brought price down where he found the first buyer. Once he found the first buyer, demand demand meets price, and then demand continues to extend price to the point where the price is so high that there's no longer any demand. That's what an auction is, and anything and everything that has a price operates that way. Okay, so what we have here, and that's the long story, the short story is the market pulled down to 69.25, and what we have here is a very clean and clear reaction to prices reaching a point where they were too low, and so we have an excess low here. The market pushes through the mid and skates along, puts in a very poor ledge here. Look at this, the way this high is created. When I draw a profile of what this looks like, very tight. See this volume here? Very tight ledge, 60, 75, 75, down to 73.50. Very tight ledge. A lot of energy here. So my expectation going into the close, if the market was to operate under its own devices, my expectation is that the overnight would have us crawling up to 78 and possibly testing it. That all changed once, on the open in the U.S. On the open, we had an immediate selling interest. Market immediately dropped 3 points on the sanctions news, and then it was further pushed down as this affects, the fact that there are sanctions. The market now has more uncertainty because now we know what the U.S. has done. We don't really know what the EU is going to do, although they announced that they will also impose sanctions. What we don't know is what the Russians are going to do, and as always, the market does not like uncertainty. The market sells equities, sells risk assets on uncertainty, and what we have is definitely uncertainty. Okay, so that's where we are. Currently, we're trading at 60.75, which is yesterday's, the prior day's naked point of control. The market's falling back to balance. I would be very suspicious of any. I would not hold strong on sell positions today. The market's just had a habit of taking in bad news, selling on it, and then finding buyers almost immediately during that session. It doesn't even wait for a session or two. It immediately buys but it's immediately bought back up, like you saw here on Yelling saying that stocks are overpriced. So with that, we're looking at the potential for the open to be inside of the value of Tuesday session. So the expectation here is for responsive buying. We expect the market to move back up to the closest value area, the most recent value area. That's the market has memory, and the most recent memory has the most influence. The expectation is for responsive buying back into yesterday's range. I'm going to be looking for a test of the value low here, the 72.50 area early. If the market opens and does not do that, but instead pushes into 67, 75, 68, and then tries to get to 69.25 and starts to sell lower below 65, then I'm going to be looking for the short sides, and then 56.25 would be the target below. Okay, so that's the key thing. There's really no way for me to tell if responsive buying is going to bring us back into range, which brings us back into 74.50, 75 for chop, and then eventually go back up to 78 once the dust clears on these sanctions, on the aftermath of these sanctions, and what that does to oil prices, oil production, and so forth. Maybe the U.S. will announce that it'll dig into its strategic reserves and supply oil, and therefore relieve that pressure. I'm not sure, but there's significant headline risk today, not only due to what happened in Iraq overnight, which is significant, in Syria as well, and then there's a ceasefire in Israel. There's just a lot going on with a significant amount of headline risk, so you need to keep an eye on that. I won't dig too much deeper into this other than to say that I want to keep it short. The the I still feel that it is a summer trade. The idea that the market's making highs on low volume, on lower volume, I don't agree with that idea, because that's how the market makes highs. It almost always makes highs on lower volume. The market sees a volume spike on the way down. So the fact that we came back up here at 1978 on lower volume does not make this a weak double top, meaning that it's probably not going to break. To me, if a market auctions away from price and is able to come back to it, to me that's a weak high. The market should not, if a high is secure and stable, it's expensive, the market should not be coming back to it. It's not likely that participants will find it cheap the second time around. So if the market manages to come all the way back to a prior high to make a double top, that makes it a weak high, and it makes it more likely that the market will find its way through it, rather than confirming that the double top is there to stay and that the top is in for this bull run. I'll leave you with those thoughts, and I'll catch you on Twitter. Good luck. Watch your risk today. There's significant headline risk. Watch your risk. Don't let things run out of control. Just stick to your risk plan, so you're back here tomorrow and the day after and the day after to continue to trade and work your kinks out. Good luck.